like I said at the beginning, we're going to now shift to the note fund updates. And so this is really where the first offerings and the first opportunities that we started in over 11 years ago. And Jim's going to kind of share some of the things that are happening in this side of our business. So, Jim, you want to take it away here?
Absolutely. So I have a book in the works too. No, I'm just kidding. So basically,
it's called Happy Hour.
It's called Happy Hour. That's right. That's my specialty. Yeah. So our place in the residential note industry is, basically it's two sides of the business. We have our income fund, which is performing cash flowing mortgages, and then we have what we call our growth funds, which are the non-performing. We buy broken loans and fix them. So we've been doing this for over 11 years, and Bob and I were in a room actually last week with John Maxwell, probably the leadership guru of the world, and he made a statement that's so simple but so profound, and it really is wrapped up in where we're at here with these note funds, and that is consistency compounds. And we've been consistently working these mortgage models now for, like I said, 11 years, and so we've established through that key relationships, some bank direct relationships, and well-positioned intermediaries, and we're perennial in the space now. We're not when I first started this, before Bob and I joined up, and I think even shortly after, I was thinking this is going to be a maybe 2 or 3 year opportunity, just kind of clean up some of the mess after the mortgage crash, the great crisis of 2008, and here we are in 2024, and we're still active in the business. We have seen inventory in the non-performing second mortgage side that has dried up somewhat, although literally as of even this morning, I had a phone call with our acquisitions director, Tom Moran, and there are a couple pretty substantial opportunities that are on the horizon, and you don't know until you know. So, but stay tuned. Stay tuned to that channel, because we'll let everybody know. But yeah, you go ahead to the next slide, Ben. So our Aspen Income. So that, again, that's the fund that buys. What we do here is we two specific asset types. There's reperforming residential mortgages. These are mostly homeowner loans and people that have had a modification done on their mortgage. They've come out of the crisis, solved their problems, and so we've been consistently buying those loans. And then the others, and that's probably about 55% of the portfolio, which is now, by the way, at about $85 million, and that's acquisition basis, that assets under management. That's not payoff balance. And about 45% of the portfolio is now what we call hard money loans, or asset-based loans, and these are bridge loans. Somebody wants to do a fix and flip, or just has to jump on an opportunity and needs fast money, and it's high interest rate money, and we love it. So it's really balanced our portfolio, because we have a lot of liquidity, money coming in and going out in the fund, but we've had a consistent, unbroken stream of payments to our investors since inception in 2014. Have not missed making our preferred returns to our investors. Haven't really even come close to missing it. We have seen yields compressing a little bit, which basically means we're having to pay a little bit more for some of the reperforming mortgages. It's gotten a little bit more competitive in the space, but we're still doing really well. And then we probably are wondering what effect has interest rates had on this particular asset class. And it's people have not been paying us off as regularly. You can see there in the slide says we had 202 payoffs in 2023 versus 342 in 2022. It's just a little harder for people to refi. There's not as much of an interest rate incentive, which we're fine with, because we're sitting and collecting a really nice, typically low teen yield on the capital. So we're making great money until they pay us off, and then we make great money. So we've seen a little change there. The value of these notes really haven't been impacted much by the higher rates. This is this asset class it's pretty insulated. There's not that many players in the space. It's not out there in the public markets. We have seen some bigger players come into the space bidding ridiculously high prices for some of these, but we're thinking that's not going to be the norm. We have a bank line of credit that is very conservative. We're typically less than 10% of the asset value is, do we have leverage at any time? But we really use that to run up our acquisitions and then backfill that by raising more capital from our investors. We are in the middle of we're just wrapping up our fifth proctology exam. Oh, I mean, financial audit. So this will be our fifth year straight of being GAAP compliant, and that's a pretty intense bit of due diligence on our fund. So that ought to make everybody feel more secure. So go ahead to the next slide. Oh, there we go. So again, the Aspen Growth Funds, these are where we buy the non-performing loans. And in general overview, as you know, those of you that have already invested with us in these funds, the courts have been backed up post-COVID, especially in some of the East Coast states. So a lot of things just weren't coming through the pipe. And unfortunately, a lot of times we don't get loan modifications done until people are under the threat of losing their home. And then they come to the table if they're going to come to the table. So that has slowed down our exits in the past few quarters. But we have seen that pick up most recently. The courts are getting unlocked a little bit. And so we're seeing some exits increase. A large percentage of our notes are in the final stages of the foreclosure process. And so we anticipate, we see some pretty large exits coming down the pike. We do, however, our workout team is still very active, and we're still achieving a lot of what I call 11th hour modifications and settlements. And again, this is when they've kind of played a lot of our borrowers, they're not dumb, and they're taking advantage of the long extended clock with some of the foreclosure process. And so they'll wait to the very, very end. And then all of a sudden, hey, I want to do a modification. And so we are getting some of those done. But increasingly, we're seeing our payoffs and our exits come from either they decided to sell the property and we get fully paid off at the sale, or we approve a short sale where we take a little bit of a discount. It's still a great profit for us. And then foreclosures actually, which isn't our preferred exit, but we do everything we can to reach out to folks. The massive increase in home values since 2020 has really dramatically increased our equity position and therefore our achievable margins. We don't have to give up as much, but we're still fair to the homeowners, but it puts us in a really nice position with these assets. There has been somewhat of a recent decline in some markets, although a lot of markets now appear to be turning back up. So hard to say, but since 2020 overall, there's a ton of equity sitting above our positions in these assets. So our leadership position in this industry has created new sources with large institutional players. Again, we're not actively raising right now for these funds, but that could change literally. I mean, we could get the right phone call in the next day or two, and that would change the story, because we do have a couple large institutions that are, we're in talks with about releasing some of their product to us. So go ahead to the next. So just really quickly, here are the three funds that are still active. I'll start at the bottom one, actually, Aspen G. This fund has operated for over 10 years, and it's now winding down. About a year ago or so, we stopped raising more money, and we stopped acquiring notes in this fund because we did start to see the supply tapering off. So basically everything that comes in, we distribute out to pro rata to our investors on a quarterly basis, except what we need for operating reserves, which isn't that much because there is good liquidity here. We have about 120 assets remaining. The book value of those is about $5 million. And the total payoff balance on these assets is 11.7. So 11.7 million, we expect that we'll end up collecting somewhere in the 60% plus or minus range of that. So for you investors that are in Aspen G, there is still a pretty good bit of meat on the bone. It just takes the time to get to reach the exits. But as soon as those loans exit, we distribute everything to our investors. So I think at the end of the day, that will have been a long-term, pretty solid internal rate of return over the life of the fund. So up to the top now, Aspen Growth 4. That was a closed-end fund where we raised all the capital, then deployed it, and then started exiting the notes. So we've been let's see, there's 123 loans left in this portfolio, and the total payoff balance is about 14.4 million. The really good news on this fund is we've already distributed back to the investors over 143% of the original capital. So basically
Boom.
everything from here forward is house money. And I don't mean our house, I mean your house. So we share it with you. So for the 14.4 million payoff balance, again, probably for this portfolio, somewhere in the 50 to 70% of that figure is what we'll still collect and bring in. So that will be going out the door to you, investors in that fund every quarter. The fund that is still open, Aspen High Yield, and it's kind of an evergreen fund. Um, we're actively working through a portfolio there. We're not currently raising money, but again, once an opportunity hits our doorstep, we're going to be putting out the call because it's typically a pretty big takedown that we have acquisition opportunities. So but we do have a pretty large portfolio still that we're working through 218 loans with a payoff balance of $30 million and the book value of about 9.5. So there's still some pretty good headroom there. And for our investors, we've maintained an unbroken monthly payments since the inception of this fund, which has been a few years now. And so all is well. The thing I wish we had was, an unlimited supply of these assets because we continue to generate, 3x plus or minus return on acquisition price. And it's been a really sweet business model for us. And we appreciate all of you that have participated in it with us. And we look forward to doing more.